Welcome to today's video. If you are sitting on substantial savings, the critical error is inertia. Cash deposits are quietly losing purchasing power due to inflation, which makes getting started essential. At age 23, you are not late. You have a head start. The focus must shift from merely saving to strategic investing. Let's move step by step and turn stagnant cash into a compounding engine. First, I'll outline the roadmap for today. Here is what we will cover in this video: why cash loses to inflation, the right emergency fund target, especially if your income is irregular, whether dollar cost averaging or investing a lump sum tends to do better, the simple path to wealth with index funds, a concrete action plan you can implement today, 2 quick quizzes to test your understanding, and a short but important disclaimer. Now, let's begin with the core problem: inflation versus cash. Inflation is the silent leak in your financial bucket. Even when your bank balance stays the same or earns a small interest rate, prices of goods and services typically rise over time. That means every dollar buys less in the future than it does today. Holding too much cash becomes a guaranteed loss of purchasing power. The solution is not to eliminate cash, but to optimize how much you keep in cash and how much you put to work in assets that historically outpace inflation. Next, let's visualize exactly how cash erodes when left idle. This diagram shows the flow from cash in a bank account through the effects of inflation. As time passes, inflation lowers purchasing power. Although you may see a nominal balance that might even pay small interest, the real value decreases when inflation outpaces those returns. The key formula to remember is that real return is approximately nominal return minus inflation. If your savings earn 2% while inflation runs at 4%, your real return is around -2%. Therefore, uninvested cash acts as a long-term drag on your wealth. Now that we understand this leak, we need a buffer for safety before investing aggressively. Before investing aggressively, prioritize a robust emergency fund. If your income is irregular, such as self-employment, aim for 6 to 12 months of living expenses. Place this money in a liquid and accessible account, such as a high-yield savings account, kept separate from your investment accounts, to avoid temptation. Whenever you dip into it for true emergencies, refill it. The goal is to protect against income shocks or large unexpected expenses so that your investment plan remains intact. With the safety net in place, we can now test your understanding with a quick quiz. Quiz time. The question is, for irregular or self-employed income, approximately how large should your emergency fund be? The options are 1 to 3 months of expenses, 3 to 6 months of expenses, 6 to 12 months of expenses, or 12 to 24 months of expenses. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is 6 to 12 months of expenses. With irregular or self-employed income, a larger cushion helps you weather variability and avoid selling investments during market downturns. Now that the safety net is clear, let's tackle a major decision point: dollar cost averaging versus investing a lump sum. Historically, lump sum investing outperforms dollar cost averaging roughly 2/3 of the time. When markets rise more often than they fall over long periods, deploying funds earlier gives more time for compounding. That statistical edge makes holding cash a disadvantage for large sums waiting on the sidelines. Dollar cost averaging can still be valuable for managing behavior, reducing regret from short-term declines, and maintaining steady contributions. But if you already have a large idle cash pile and an adequate emergency fund, the data supports deploying that cash promptly. To make the distinction even clearer, let's compare these approaches side by side. On the left, lump sum investing provides faster market exposure, wins historically about 2/3 of the time, and maximizes time in the market, though it can be emotionally difficult. On the right, dollar cost averaging smooths the entry, reduces the chance of regret after a decline, and supports strong process discipline. However, when markets trend upward, DCA often lags because cash waits on the sidelines. With that overview, here is a quick quiz to check your understanding. Here is the next quiz. Historically, which approach tends to outperform more often over long periods? The options are dollar cost averaging by more than 2/3 of the time, lump sum investing by roughly 2/3 of the time, they perform equally on average, or it depends on lunar phases. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is lump sum investing by roughly 2/3 of the time. This is because markets tend to rise over long horizons, making earlier exposure beneficial. Now that we have addressed how to enter the market, let's simplify what to buy. The core of a winning strategy is to use low-cost, broad market index funds. A U.S. large-cap index like the S&P 500 is a fine starting point, but consider global diversification by including international stocks to spread economic and currency risks. Keep fees low, automate contributions, and resist the urge to pick individual stocks or time the market. This approach, often referred to as the simple path to wealth, captures broad economic growth with minimal complexity. Next, let's sketch a portfolio blueprint to make this concrete. This class diagram shows a sample portfolio. The policy might be 80% stocks and 20% bonds for a young investor, adjusted for personal risk tolerance. The equity sleeve combines U.S. and international index funds, including developed and emerging markets. The bond sleeve is a diversified, high-quality index, such as a global aggregate, with short to intermediate duration for stability. Rebalancing can occur annually, or when allocations drift beyond set thresholds like 5%. Now let's highlight why fees matter so much. This table contrasts typical fees. Broad index funds often charge a few basis points, costing $30 to $100 per $100,000 per year. Active funds commonly cost several times more. Over decades, that gap compounds into a large difference in ending wealth. Lower fees leave more of the market's return working for you. With the building blocks clear, let's turn your plan into action. Follow these 7 steps. First, set your emergency fund target at 6 to 12 months of expenses. Second, open a high-yield savings account for the emergency fund and a low-cost brokerage for investments. Third, select broad, low-cost index funds covering U.S. and international markets. Fourth, if you already have a large cash pile beyond your emergency fund, invest it as a lump sum. Fifth, establish automatic monthly contributions tied to payday to build discipline. Sixth, rebalance annually or when allocations drift by around 5%. Seventh, conduct a short annual review to confirm your plan still fits your goals and risk tolerance. To help you visualize the rollout, let's look at an implementation timeline. This timeline shows a 12-week rollout. In weeks 1 to 2, set your emergency fund target and open accounts. In weeks 3 to 4, select index funds and define your policy. In week 5, deploy the lump sum beyond your emergency fund. During weeks 6 through 8, activate automatic contributions and confirm they run smoothly. Weeks 9 through 12 focus on tracking, record keeping, and setting a calendar reminder for annual rebalancing. Before we close, a brief but important disclaimer. This video is for educational purposes only and does not constitute financial, legal, or tax advice. Investing involves risk, including the potential loss of principal. Everyone's situation is unique. Please consult a licensed professional to tailor any strategy to your needs. With that said, let's crystallize the key points you should remember. The key points are as follows. Inflation causes cash to lose purchasing power over time. If your income is irregular, hold 6 to 12 months of expenses in an emergency fund. Lump sum investing historically outperforms dollar cost averaging about 2/3 of the time. Broad, low-cost index funds form a simple yet powerful core strategy. Finally, automate contributions, rebalance periodically, and stay consistent. Now let's summarize the entire plan in a few lines. In summary, cash is a headwind against your wealth if left idle. Build a proper emergency buffer first, then invest the remainder. For large cash balances, prioritize lump sum deployment. Use low-cost, globally diversified index funds as your core. Automate contributions, rebalance periodically, and allow compounding and time to work for you. To wrap up, here's how you can support the channel and share your thoughts. Thank you for watching. If this video helped you, please like, share, and subscribe. I would love to hear your plan in the comments. Lump sum investing, dollar cost averaging, or a blend. Your feedback helps shape future content. See you in the next one.